Everyone, welcome to the Dojo. I am Sensei Kevlar. Welcome back from a hopefully incredible Thanksgiving vacation. I know these markets have been doing incredible things. Today's Monday, so we're going to start out with a Mindset Monday. Let's take a look at BTC, what BTC USDT is doing. We'll take a look on Bitstamp, not that it matters. Prior to now, I had estimated that the market could do this or it could do this. Well, it did this. Hopefully, those who are holding on to Bitcoin are celebrating at this point. Should they still be holding on to Bitcoin at this point? My argument to you is that every time that Bitcoin has done one of these, it then does at least one of these. If it does one of these, it tends to do one of these. Now, what we're talking about here is we're talking about technical analysis. We're looking at the markets and we're saying, this is what the market has done in the past. Therefore, I think the market might be prone to repeat that pattern. We've seen that markets repeat patterns when we look at Fibonacci trends, and we see how they, work within standard deviations of those trends. We've seen that Bitcoin, over the long term, let's get rid of this, tends to have a long-term trend. Let's see if we can measure. I don't really think we can, but we'll see what we can do. We'll take that point to that point and extend it on into the future. We'll take that point to that point and extend it on into the future. We're definitely seeing acceleration of the trend. What about on the other side of that? We'll take this point to this point, extend it out into the future. Yeah, see, we intercept right here. We broke the trend. We'll take this point to this point, and we'll extend it out into the future. And here, look at what happened. We broke trend again. Now at this point, what we have to do is we have to take this point and extend it out into the future. This is our new technical analysis of the trend that we seem to be operating within. This is where we think the market can go moving forward if we continue this upward trend with an expansion on this volatility. We're definitely seeing expansion on this volatility. What we're doing is we're looking at the technicals of the market. We're looking at the technical analysis. Now, meanwhile, there's a whole other aspect of this that is coming into play. And that's what people are hearing. What people are looking at the fundamentals of the economics, right? When you type Bitcoin news, they see this. 10,000, Bitcoin's huge. It's going up in 2017. They see that the hedge funds are coming in. There's lots of people who are getting into this market and pushing it upwards. Does that mean that, it has to come down? No. It can still continue upwards. It can keep going forever, for all that we know. It doesn't have to follow these trends. It just tends to. It's statistically likely that these trends will emerge in some long-term fashion, but over the short term, it can just keep on doing one of these. Keep on going and accelerating and creating all new highs. Or it can come crashing down. You're going to need a plan that has you ready for both. And technical analysis will only tell you so much. Fundamental analysis The reason that something fundamentally has the price it does, the reason for it to fundamentally exist, the reason that the fundamentals of the economy are the way they are, the fundamentals of Bitcoin play strongly into the nature of the price, into the value of the price. And these are what determine the trends long term. Not just the technicals. The technicals will tell you, what might happen in the short term, but long term, the fundamentals are going to tell you much stronger. The fundamentals will tell you that Bitcoin has had a huge rise in its price, a huge growth in its market cap. So has Ether and Bitcoin Cash. These are all huge markets. In fact, we're seeing green days across the board. Believe me when I tell you that back in October, we were seeing red days across the board, and every chart looked the opposite of this. If you were buying in October, you were rich in November. If you're buying in November, does that mean you will be rich in December? I'm not sure. But I can tell you those who sold a portion of their stuff in November will be ready for the trend that changes in December. And those who planned for November to continue into December and January and February by only selling a portion and allocating the correct amount of their portfolio for this trend that we're seeing right here, will have more money to make in November and December as well. Diversification means doing it all. And having a plan and trading the plan means having a plan that has you diversified for every market motion, for every market condition. So what we're going to do today is we're going to look at trends. We're going to look at how we can extrapolate trends. I showed you one way in which I took a bottom to a bottom and then pushed it into the future, and I saw where the trend got broken. And then I took a bottom and I pushed into the future, and I saw where the trend got broken. Here we took a top and a top, and we saw that that trend remained valid for a long time. Even here, remained valid for a long time until it wasn't valid anymore. When a trend gets respected, this is as good as having a resistance level right at that line. It's a point that's telling you, from a technical perspective, what the trend might do. Now, if you were, counting on your resistance levels coming in here, your Fibonacci levels coming in here and telling you that Bitcoin was done at this point, well, you got surprised. Don't get surprised. Plan for this surprise. Now, when I look at these trends, it's obvious to my eye that these trends are up long term, and it's obvious that within these trends, there's smaller trends, up and down, short term. These smaller trends can definitely tell me something. Look at this trend right here. This trend right here tells me that we've recently had a big run up, and we'll probably see a big run down afterwards, because every time we see a big run up, we usually see a big run down afterwards, followed by a big run up. And then we were probably expecting a big run down, and what did we get? A big run up. Could we expect some sort of correction right here? I expect so. Should we plan for that? Absolutely. Should we also plan for it to turn around and go back up? Absolutely. Should we plan for it to just keep on going? Yes, we should. Because that's the trend. The trend is what tells you how to plan long term with your allocation. Your allocation is how you plan. Now, what I've done so far is I've looked at these trends, and I've done this in sort of an automated hodgepodge fashion. But there's better ways of thinking about these trends. You see, what these trends are really doing is these trends are looking at the rate of change over time. And what we want to do is extrapolating information, extrapolating data. Well, that's a computer's job, man. Computers are really good at that stuff. What we want to do is we want to have a way of extrapolating the data and determining the trend without actually having to sit here and draw these lines. In the same way that we can use the Fibonacci to discover our standard deviations within the market, we can use more tricks, we can use more analysis to discover the trend in the market in a completely automated fashion. So today we're going to break down how to do trend analysis. Let's start by breaking down what a trend looks like. A trend looks like a change or a lack of change over time in the direction of the market. This is an upward trend right here that it got extended into another upward trend right here. This is an upward trend that turned into a downward trend before the trend reversed and went back up again. What we're measuring in these trends is we're measuring that during this time frame right here, we went down more than we went up. During this time frame right here, we went up more than we went down. We can do this in an automated fashion by extrapolating the numbers and looking at the difference between them. The difference, that's the key word. In math, the difference is the same thing as saying subtraction. So let's take a look at how we might do something like that. Let's take a look real hard at these candles. These candles have 4 pieces of information buried within each candle. Within each candle, you have the open, the high, the low, the close, and actually there's a 5th piece of information being displayed down here, the volume. Let's just take one of those pieces of information. Let's take the close. Let's only work with the close. This is the close here, this is the close here, close, close, and finally the close. Because we have a red candle, before we are working with the tops of our candles, when we have a red candle, we're going to take the bottom of our candle, because that's the close. If we had to take the values for those, we could take specific values. We could say that this close was 9,154. Excuse me. This close was 9,271. This close was 9,466. 9,598. This close over here was 9,526. This close was higher than this close. This close was lower than this close. That's what I want to call your attention to. So now let's extrapolate that information. Let's take it out of the chart and let's do some analysis around it. I'm going to use some made-up numbers here. And don't worry about the rest of this for right now. Okay? Focus with me for 1 minute on the relationship to what I just said about closes and pulling them out of a chart. Let's say that I wanted to start back here and I wanted to take all this data out of the chart and put it into a series of data, put it into a spreadsheet. And I was just using some made-up numbers. I'm not really going to use the 9,000 numbers. I'm going to use some easier numbers to use. I'm going to use, 44. Okay? Let's say that my first close here was, 44, 0.34, 4409, 4415, and on and on and on. What I'm doing is I'm taking the close out of each one of these in my series, and I'm putting it into here in my series. Okay? Then what I'm going to do is I'm going to take the difference between this candle and the next candle. I'm going to take the difference of the close because the difference will tell me if I closed above or if I closed below. So here is the change. The first one I don't have a change because I have nothing to compare it to. But the second one, I went from 34 cents to 09 cents for a difference of negative 25 cents. After that, I went from 09 cents to 15 cents, a difference of positive 6 cents. From 44.15 to 33.61 is negative 54 cents. Then we bounce back up to 44.33, a difference of positive 72 cents. On and on and on down for 33 bars of my 33 candles of my chart here that I've captured out of my chart and I put into my spreadsheet. Okay. And you can see this is just, here I have the actual values. Here I have an equation for, C4 minus C3, and that goes here. This one is C5 minus C4. This one is C6 minus C5, predictably. Then what I do is I'm trying to figure out how much gain and how much loss I actually did, because that's what I'm really interested in. Okay? Is I want to take, in this case, I had no gain. I only had loss. So I put the actual amount of loss, the absolute value of the loss, into the loss column here. Here I had gain, gain goes in here. Here I had loss, the actual amount, not negative but positive, the actual amount of loss goes into the loss column. So what I'm doing now is I'm measuring the amount of gain as a positive decimal. Here I'm measuring the amount of loss as a positive decimal. What I'm doing is I'm making these two numbers comparable. Here I should be able to see, amounts of gain, and here I should be able to see amounts of loss that I can compare with each other because they're both positive. Then what I do is I take the moving average. The way a moving average works is I take, 14, for instance, I'm just going to pick a number at random, 14 values, and I average them together. So what I'm going to do is I'm going to take these 14 values and I'm going to average them together to form this row right here. Okay. Then on this row, I'm going to take the next 14 values, except instead of starting here, I'm going to start here, and I'm going to go all the way to here. I'm going to average all of these values together. And then for here, I'm going to start here. I'm going to average all of these values together. In this way, you can see that the window of moving of numbers that I'm averaging over shifts over time. It moves over time. We call this a moving average window. So, and the whole point of this is what we're doing is we're doing this for averaging the gain and averaging the loss over a moving average. What we're really doing is this is the same as saying, okay, let's figure out where we are here by looking 14 numbers back and averaging all the difference, okay? So if I want to compute the value for this bar right here, I have to look 14 bars back and compute my average gain and average loss. Then what I do is I take the average gain and I divide it by the average loss. Okay, so here it is G17 divided by H17. No, that's not right. It should be F17 divided by G17 equals F17 divided by G17. We probably need to get some more precision in here. I know, it's just too small, isn't it? Yeah, it's just too small. What is it, G? Oh, no, I did have it right, didn't I? No, I had it right. Yeah, that's why. It's G17. My bad. It's G17 divided by H17. And if you just put an equal sign there, Sensei, that would be great. There we go. Okay. What I've done is I've taken the average gain and I've divided it by the average loss. What this has done is this has given me what we call the relative strength. Because what happens is that this number floats somewhere around 1. And when we end up with more losses than gain, it goes below 1. And when we end up with more gains than losses, then it goes above 1. Then what we do is we take a neat little graphing trick in which we take 100 and subtract it from 100 divided by 1 plus the relative strength. So here's that formula plugged in right here. And what this does is this makes it centered at 50. Instead of being centered at 1, like it is over here, it makes it be centered at 50, because you're taking you're subtracting 1 from 100 divided by 1 plus the number, which makes it centered around 50. So what it does is when we go to 1 here, when we go to equilibrium, we go to on 1 here, we go to 50 in our RSI. Okay, so what this does is this tells us what the relative strength index. This is the relative strength. This is the relative strength indexed against 0 to 100. What this does is this tells us if we're going up, if the trend is going up or down, and how much it's going up or down relative to the previous amounts that it's been going up or down. Relative to the previous amounts that it's been going up or down, because each calculation considers the last 14 average in a moving average, the last 14, the last 14, the last 14, the last 14. Okay, so it's considering where we are at compared to where we have been in the last 14, because I picked a moving average window of 14 to compute my RS, to compute my moving average window with. Now, obviously, you're not actually going to come in here and do this on your own. You're not going to sit here and take these silly numbers and put them into the worksheet. What I needed you to do is I needed you to see how this is built. I needed you to understand that what we're doing is we're taking the price, computing the difference in change, sorting them into columns that relate to each other in terms of the amount of change, computing those over a moving average, computing the relative strength of those relative to each other, simple division, and then indexing that against a 0 to 100 range. The whole point of this is it makes pretty pictures. Let's see what it looks like. Let's take a look at what's happening here. At the current moment, in order to plot this point right here, what we had to do was we had to take the previous 14 bars back and compute their relative strength by taking the closes, taking the change of the closes, taking the gain and the loss, computing the moving average over that 14-day period, and we ended up with this number right here, a 70-ish, right? A 75, okay? So that's what number we computed by looking at this and looking 14 back. In order to compute this number here, right here, this 85, this 87 right here, we had to look at this one and look 14 back from here and do this math all over again. And in this way, we computed programmatically the relative strength of the trend. Let's look at what happened here. Previously, when the relative strength showed that we had a trend that exceeded the prior trend, and that trend was above 70, the next thing that happened was a fall. Here we've got a trend. Here we've got a new trend that exceeded it. Here's the fall. Okay? Here we've got a trend. Here we've got a trend that exceeded it. The RSI is already telling us that we're moving downward, that the trend has stopped and changed direction. You can see it on the RSI, you can see it on the chart, okay? But what's more is that traders are looking at this constantly. They're looking at this and they're saying, oh, look. The RSI came down. It came down below 30. The RSI came down below 30. What happens every time the RSI comes down below 30? Was it a good time to buy in Bitcoin? Well, yeah, it was. What did our technical analysis tell us with regards to our trend? Our technical analysis told us with regards to our trend that the trend had overextended itself. And previously, when the trend had overextended itself that much, it went back up. Previously, when the trend had overextended itself that much, it went back up. Previously, when the trend had overextended itself that much, it went back up. What you're looking at is you're looking at an automated trend tool. You're looking at an automated way to analyze the market, to automate the analysis of the market, extrapolate the information, and perform analysis on the market in order to see what the trend is. The trend at this point in the market is overextended. The trend at this point in the market is overextended. Now, what could happen next? Could we come down? See it come down to here and then go even higher? Absolutely. You bet we can. But look at what's happened here. Previously, when the market goes sideways for a minute and then it goes up, it usually goes down above 50. Anytime it goes up, it usually goes down above 50. Anytime it goes up, it usually goes down above 50. What happened here? It sort of went down to 48, almost, not really. What this is showing us is that this trend has been on a roll for a while now. If you're looking for a correction, now would be a good time to look for it, according to this trend. According to this trend, we've had a recent trend, no real correction below here, and then an even bigger trend that got extended. Anytime that happened in the past, we usually saw a correction. I'm not saying that that's really what's going to happen. What I'm saying is that you can use these tools, you can automate your analysis to strengthen your strategy. How does this affect the plan? Well, if you were planning on being in distribution, let's bring in our fib tool. Let's start bringing the plan together. Do the fib retracement off of this guy all the way up to here. Where could we come down to? Well, I tell you right there is probably the answer. Right there and right there are probably your best bets. I'd say we definitely see a lot of price action right at those levels. And those are correlated fib levels. And there it is again on that. I think we're probably bouncing off of this guy pretty well. Now, how does this affect the plan? Could we be selling potentially more here? All of it? No. Some of it? Yes. Why? Because according to our plan, the plan could include that a portion of our allocation gets held on to for selling until the RSI goes above 80. And then we sell it out. Is normally we're just doing normal distribution, but then a second part of the plan is we have a trophy that we're holding on to, and we sell it out above 80. Then we buy it back $300, $500 cheaper. Then we just wait for the RSI to go above 80 again. Okay? Same thing with the RSI going below 30 or below 20. Here it went below 20. Could we have bought a bunch right here at the RSI below 20? Could we have been reserving for the RSI below 20 right here and done the best buys of our lifetime? Oh man, if you had bought that dip, if you had bought that falling knife because you had seen your RSI go below 20 and you had just been waiting like a viper waiting to strike. Why? Because you had a plan in place. So let's go over how we got to this again. Rather than sit here and take these numbers out and put them into a spreadsheet, what I did is I came up here and I went to my indicators. I have so many wonderful indicators here. I really do invite you to explore all of them. I cannot possibly tell you all of them, and I cannot possibly tell you what good ones, which ones are good or which ones are bad, or which one to use on which market, or what the settings are for them. All I can do is tell you how they're built, and later I'll show you how to build them yourself, and why they're useful, and how to use them. So let's go over here to the built-ins. We'll scroll on down to our relative strength index. Click that button right there, and this adds our relative strength index to our chart. If I come over here and I click on this format button right here, you can hide it. I can apply indicators on it, or I can format it. If I go to my inputs, I can change the length. Remember before when I said 14 bars back? What if I make that 20 bars back? How does that change things? Well, it makes it a bit smoother. What if I make it 40 bars back? Even smoother. Now I can really start to see where those trends happened that, we turned around from. Here's a trend we turned around from, right? And then we went sideways. We went back to the norm. We went completely back to, look at this. What this is telling us is this is a return to the norm. This is sideways motion right here. Is when we went up and then we went to sideways motion. This would be downward motion. We saw no downward motion in this time frame. None to speak of. It went up and then it just kept going up. This is the first sign of downward motion that we saw over a 40 close period. Right here. This is the first time we saw any sort of trend reversal over a 40 close period. And here we are again. Now, on one hand, you might say that this trend is running out of steam. Right? This has become so much the norm that we're no longer shocked by this on the 40 average. I think that these are all valid ways of looking at this. And any valid way of looking at this is a way that another trader is looking at it and making decisions off of it. Are they looking at this and saying, you know, I think this thing's really run out of steam at this point. Look at it come down. You know, I look at the markets right here. Look at the volume. I think this thing's really run out of steam right here. Look at it come down, right? Plan your trade accordingly. Plan to have sold the majority of your opportunity right here so you can buy the majority of your opportunity back all down through here. But make sure that you have planned to sell all the rest of your opportunity all through up here. Don't want to be caught. Now, what we've done so far is we've looked at the trend over a singular time frame. What I want to do now is I want to look at the trend over multiple time frames and how they compare with each other. In order to do that, I'm going to use a slightly different indicator, one called the MACD. The way that the MACD works is it's like two RSIs, except there's a couple things that are different about it. The first thing that's different about it is that the RSI uses a standard moving average window. The MACD uses an exponentially decaying moving average window. What that means is the further back in time that you go, the less relevant in the average your number becomes. It becomes decayed over time, so that trends further back in time have less weight over time. The other thing that's different about it from the RSI is it's using two periods for its look back. A 12 and a 26 moving average window is the standard. Okay. Now, what we're seeing here is we're seeing that same smooth trend line over time, but we're seeing something else different. What we're seeing is we have what we call the fast and the slow trend line. The fast trend line responds very quickly to changes in motion, because what happens is it's only looking 12 periods back. So any change in motion, it's able to quickly move. Whereas the 26 has a lot of history dragging it around. Has a lot of history in every single moving average. Over twice as much as the fast one. So it's much slower to respond to change. The slow trend line is the blue the fast short trend line is the blue trend line. It moves very quickly. The slow long trend line is the orangish yellowish orange trend line that we can see right here. I'll call it orange. It moves much slower and is much slower to respond. What you can see, though, is you can see there's one more thing here. This is the histogram. This is measuring the difference in the slow and the fast. So when you have the slow and the fast equal to each other, the red histogram right here, these red lines right here, goes to 0. And then when they diverge, you see growth in the histogram. So the more divergence between these two, the more separation between these two, the more red histogram you're seeing. So that's why this thing is called the moving average convergence divergence. It's measuring the divergence, the separation, and then resulting convergence, the coming back together, where they converge and come together at that point. Okay, so what this is measuring is fast trend reversals against slow trend reversals. And what this is saying to us is when the fast trend meets the slow trend, the trend has changed. Let's say this is more like our 40, right? Let's make this really nice and smooth, right? So here, what we're saying, let's take a look. bring this in, and let's take a look at what happens when the two numbers cross each other. Okay, the fast and the slow cross each other. Right here, we were definitely in a downward trend. We both agree the slow and the fast were saying, no, we're pretty much heading down this whole time, and the divergence is, unchanging. We were steadily heading down without any change in trend. Then, at this point right here, we signaled a trend reversal. The two lines crossed again. Here they had been divergent. Here they became convergent. And we had a crossing, and the red histogram went from down to up. Well, what if you had bought on that day? You would have bought somewhere in this market right here. Okay. If you had sold up here and you were waiting for your MACD to tell you, you would have bought right here. Well, if you were waiting for your MACD to tell you again that it was time to sell, you would have sold right here. Bought here, sold here, just according to the MACD crossing. Could you have bought right here when the trend showed that it was reversing itself? We were in a downward trend, and then bought right here. You would have bought on this day right here. You would have bought this candle right here. What are we doing now? Are we waiting to sell? Waiting for this MACD, the fast, to come and meet the slow and give us a nice crossing to show that we're going to come back down, do our selling, and wait for our buy to come back down here? Well, sure, why not? This is the way of the trader. Is not only are you taking one signal, one, but you're taking two signals, 1, 2. Did you buy here? No, you only had one signal. Did you buy here? Yes, you had two signals. How many signals can we bring in? Here, we were coming off of a support line. MACD was still showing divergence. RSI was in a market middle. Could we have avoided buying? I think so. Here, again at a support line, no different than being at a support line here. Support, support. What was different? We had just hit RSI below 30. We had just hit MACD crossing. Would this have been a better time to buy than right here? My answer is yes. It would have been a better time to buy. By combining technical analysis with fundamental analysis, by looking at the trends long term, by automating your intel, by automating your market analysis, by automating your trend extrapolation, by automating your feature extrapolation and drawing the trends in such a way that you can correlate them to market motions. You can correlate 1, 2, 3, 4. Can we get some news? News? Bitcoin news? 5. How many positive signals do you need before you buy? Well, my answer is go back and find out. Go back and find out where the best times to buy were and see how many market signals you needed to tell you that those were the best times to buy. If this was the best time to buy in the market, how many signals could you make right there? At this point in the market, when it's popped back up, when we've gone below 30, when we're doing a MACD crossing, what was news like on that day? 1, 2, 3, 4, 5. Now we buy. We're here, we can only get 3, we're still in divergence, we don't buy. Hasn't gone to 20 yet, we don't buy. Would we have gotten a better price by not buying on 3 but waiting for 5 signals? Yeah, we would have gotten a much better price. We would have gotten a price of 4,200 to 3,200. Holy moly, that's a lot of money. That's a ridiculous amount of money. Look at what would have happened. We could have sold that off at 5,600 here on the MACD crossing above, on the RSI above 80, on news. Okay. How much? All of it? No. You save some from up here, and then you sell more on the MACD crossing, RSI above 80. All of it? No. You save more of it for up here, but you buy it down here when we get the MACD crossing, RSI below 20, RSI touching 25. News. 1, 2, 3, 4, 5. Build your strategy. Backtest it. Go do it in every market. Find the market that's going to make you the most profitable. Find the market that you understand how to be the most profitable in, no matter what the market does. Then go maximize your opportunities. Then go maximize your understanding. Combine technical analysis, which is going to be wrong half the time, with fundamental analysis, which is going to be wrong half the time, and make yourself wrong less than half the time. And make sure that you have a plan so that the other 49% of the time that you're still wrong, doesn't matter. You still got money. You still got market to roll. You still got cash to go. You still got Bitcoin to sell. Why? Because you've allocated. Because you remember in the first week of the dojo, we talked nothing but about allocation and distribution strategies. We focused exclusively on how to schedule your allocation and distribution. Now that you know how to schedule your allocation and distribution, schedule it against your technical and fundamental trend analysis. Maximize your opportunities and plan for every single market motion in every single market condition, because they all will occur eventually. Every last one of them. Plan the trade and trade the plan. And that is the way of the trader. Thank you very much, everyone.